Micron Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
G'day, welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So to the overnight session, global equities somewhat mixed. Bond yields and the US dollar did rise modestly as Federal Reserve Chair Jerome Powell testified before Congress. While he gave no indication as to when the central bank's easing cycle would begin, he said more good data would strengthen the case for rate cuts. Now on Wall Street, the S&P 500 and Nasdaq again closed at record highs as optimism about the growth of AI offset uncertainty about the Fed's rate cut path. Nvidia helped fuel the gains, offsetting declines in other chip stocks, while Tesla also added to its recent gains. Shares of JP Morgan, Wells Fargo and Citi climbed, with the three banks releasing quarterly results on Friday, marking the beginning of second quarter earnings season. They also got a boost from reports that the Fed is considering changing how it calculates an extra layer of capital it imposes on US global systemically important banks, which could save them billions of dollars. Well, the US is no longer an overheated economy, Fed Chair Jerome Powell has told the US Senate Banking Committee.
This recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic.
He went on to say the central bank's policy path remains finely balanced.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
The Treasury yields inched higher as Jerome Powell signalled that further progress on inflation would set up interest rate cuts later this year. Futures markets are anticipating 50 basis points in interest rate cuts by the end of December, with the first cut coming in September. That's according to CME's FedWatch tool. Investors are now waiting on June inflation data due out tomorrow night for more clarity on US interest rates. The yield on the US 10-year Treasury note rose to 4.3%, the 2-year at 4.63%. The US dollar did gain following that Powell testimony. Meanwhile, the euro has dipped as investors consider the hung parliament in France, with leaders from the left-wing bloc that won the most votes in the elections saying they intend to govern according to their tax and spend program. The Aussie is at 67.4 US cents. Let's get across what is moving, certainly as far as the US economy is concerned, reaction to those Powell comments, and more broadly what we're seeing with equities. John Blank joining us from Zacks Investment Research. John, welcome. Good to catch up with you again. Let's start with those comments from Jerome Powell to the Senate Banking Committee. Anything that you got out of that actually has altered your view as to where the Fed's likely to take rates?
Not at all, Andrew. I think the only thing that came out of that discussion for me is that the Fed has always had a dual statutory mandate of stable prices and low unemployment for the households, and he spoke to both of them for the first time. So that is kind of, I think, giving a good signal that he's taking seriously both mandates for the first time, not just the price inflation mandate, which means he's worried about higher unemployment, which means in the market context of the Fed policy rates that he probably will do 50 basis points of cuts with SEP and DEES probably is a good benchmark. The CME futures trader read that right. They're at 75% on a SEP cut, which I totally agree with. I think, you really have to have a base case that the Fed's going to cut, not only because of those dual statutory mandates, but because also we've got such leadership out of the ECB. We've got a 161 yen. There's plenty of reasons outside the United States as well for the Fed to start cutting rates.
Now, of course, this comes before that all-important read on inflation that we're going to get towards the end of the week. What are the expectations?
I think we're going to get very little out of the inflation report. It's going to be a sideways movement, and we're going to still talk about the shelter cost component being the major issue here. We still have in my opinion, what hasn't been put in the news with Powell that he deserves the criticism for is that he made a Fed policy mistake with the housing market. He took inventories down in 21 and 22, way lower than they should be. Now they're climbing back up, but we're several 100,000 units away from the housing inventories we had in 2019. So while he did say the labor market is cooling to 2019 levels, that's true. The housing market is way, way too tight, keeping housing prices way too high and keeping the pressure on the shelter cost component. So the other subtext here that he didn't speak to, that I will speak to somewhat critically, is that I don't think his decision to keep the Kiwi monthly, bond buying as strong as it was and zero rates for as long as he did, he's got to take some ownership of that shelter cost component right now for the next 2 years.
John, investors also very much are looking towards second quarter earnings season, which gets underway on Friday with the big banks. What are the expectations?
Yeah, Andrew, just keep it simple. 9% earnings growth from Zacks, and we got a 1.7% revenue growth rate for the second quarter. 1.7% revenue growth rate, probably the most interesting number, Andrew, because what it shows you is that actually the S&P 500, which contains 40% revenue from abroad, is basically at what the GDP growth rate for the second quarter is going to turn out to be when GDP now gets looked at, pretty much the same. So profitable enterprises at this level of activity, 9% growth rate, but not a lot of growth in the revenue base. And, if you take the banks out, it gets a little better. So I think, what we're going to get out of the way here, which we might get a bump up on the revenue growth rate, is we get the big banks reporting. Maybe we get some of that out of the way, and it'll start to crank up those revenue growth rates. But at this point in time, it's pretty clear that, Powell's got his slowdown in hand. The S&P 500, Q2 earnings expectations are in line with that.
John, let's get to those stocks you focused on there at Zacks. The first one being in the retail space with Gap, the apparel retailer. What are you seeing there, I guess, particularly with the consumer having been under pressure? How has Gap fared?
Yeah, Gap is an interesting turnaround story, Andrew. The last 2-3 years, they've been in a turnaround situation, putting a lot of pressure on, getting their costs underway. You got to remember, Gap is 55% Old Navy. So it's basically a pretty cheap clothing store, for the most part. You have Athleta, you have Gap and Banana Republic, but at the end of the day, Old Navy's half this business. So there what you have is a really classic story of a stock getting back up to its highs. 35, on that chart in 2021 is where we can get to. We've got a price target 27, which you can see with our earnings estimate lines are really, pretty consistent. So you got to love a chart like this when you see 24, 25, and now 26, which is the brown line, starting to see that smooth ratcheting up of earnings. That's why we give this stock an A for long-term investors and a 1 for short-term investors, because everything's coming together for Gap right now as a stock.
John, the next stock we're going to take a look at is in publishing, which interesting because publishing globally under enormous pressure at the moment as we see that structural change occur. We're going to take a look at the New York Times company. What are you seeing?
Andrew, this is a great stock to talk about. So yeah, we have one of the most classic old school newspaper franchises in the United States. They have a subscriber base of just under 10 million. So let's keep the math simple. It's 10 million. So with a 10 million subscriber base, you can see from 23, 24, 25, 26, 3 to 4 years, the New York Times has been running a bundled subscription strategy to build this business. So they are getting subscribers online, but what they're also doing is they're bundling it with cooking, with games, and they bought a sports company. So what's interesting here is if you're really tired of Facebook, if you're really tired of all the mismanagement of news out there, this is one of the premier, if not the premier, news franchise in the United States. And they are bundling and they're figuring a way out to be online and make money. So as you can see here, we got a 2026 call for $2.20 a share on a newspaper company. Just take a step back and think about that and realize, wow, one of the solutions to a lot of misinformation here is is for someone to figure out how to turn around the New York Times and things like it, and that's what's happening here.
Yeah, that's fascinating, particularly given, as I mentioned, so many media companies losing money at the moment. John, certainly one sector that is, well, if you're in that, you're making money, is in defence, and the next stock is Elbit Systems, what it supplies the US Army.
Yeah, Elbit Systems, Andrew, it does supply the U.S. Army, but 3,000 people in the United States work for this company, but 18 or 19,000 work for it in Israel. This is Israel's big defense supplier. 85% of the IDF, the Israeli Defense Force, aeronautic stuff, the drones in particular, come from this company. So why are we talking about it? Because you can see that blue line, 2024, the earnings numbers just popped about a month and a half ago or 2 months ago. We all know what that is. The U.S. passed a defense appropriations bill for Israel and for Ukraine. So we just got to think about it purely from an economic perspective. That passage of that fiscal stimulus is lifting stocks like Elbit into number one ranked stocks. So you can love it or hate it, but at the end of the day, geopolitics and war are money makers for some companies. And when you have 85% of the IDF budget and you have super high tech devices that are getting enabled by all these combat situations that people are learning about, drones in particular, precision munitions that target people from hundreds of miles away, you got to take a look at Elbit Systems or at least know about it.
John, great to get your view there at Zacks Investment Research. Thanks for joining us.
You bet, Andrew.
Let's take a look at what we're seeing locally, and we'll set to erase some of those, most of those gains we made yesterday, in fact, on the local market, with SPI futures off more than 0.5%. Stay with us because the open is just a couple of minutes away.